Hi there everyone, and welcome to OpenCorp's monthly webinar, Behind the Numbers, what the property market is telling us right now. We've got a bunch of juice, sit tight. It's going to be a really action-packed 60 minutes that we're going to be sharing with you today. Just to give time for everyone to jump on, because we have had over 1,100 registrations for this webinar. Let's give us 15 to 20 seconds for everyone to jump on, and I'll kick off very, very soon. Okay, let's start. Thank you very much for joining us today. For those of you that don't know, Michael Beresford is my name. I'm the Director of Investment Services here at OpenCorp, one of the 4 partners in the business, and have been investing myself for nearly 20 years. We're going to be sharing a whole bunch of great stuff with you today, including insights from our special commentator this month, who is Tim Lawless. Tim is one of the most sought after speakers and experts within the property market in Australia. He's the head of research for RP Data CoreLogic Asia Pacific, so it doesn't get any better. But before we get into Tim, what I'd love to do is welcome back all of our existing viewers that are familiar with our webinar concepts, and to all of our new viewers, you're in for a great treat today. Hope you get some fantastic value out of the information. So obviously we're interactive through GoToMeeting. One of the great things that we can do is get some feedback, as well as sharing information with you today. It's also about giving you the information that you're after. So in the sidebar there, please write your questions down, submit them through. We've got our team working in the background to collate those, and we'll have a live question and answer session at the end of the webinar today. Make sure we can get through as many of those questions as possible. There have been over 100 sent through already, so we'll get to as many as we can, but we'll make sure that you get the answers to the information that you're after. So just a quick show of hands to start. Who caught the last month's webinar with all the market insights from Nera and Conisby? Okay, awesome. And one of the other things that we'd love to be able to do, obviously everyone is going to be on different stages of their investment journey. So if you could give us an insight in terms of who's with us today online. Are you just starting out on your investment journey? Do you have a small portfolio looking to grow that? Or thirdly, are you an experienced investor looking at ways that you can tweak and accelerate the performance of your portfolio to improve the financial goals that you're able to achieve? If you could just click on one of those hot buttons on the poll there and let us know, that'd give me a really good picture on who's joining us today. Okay, wonderful. We've got a fantastic spread across all 3 of those. It especially looks like we've got some people that have started their portfolio, maybe looking to grow that, looking to do things a little bit better. I'm sure the insights from me and from Tim will be helpful in allowing you to do that. A couple of very quick housekeeping items before we kick off. Again, a reminder about the questions on the right-hand side, and secondly, if you do have to jump off, or if you do want to be able to recap all of the juice that we share with you today, you'll get an opportunity to do that. An email will be coming out to you shortly with a recording of today's webinar, as well as an offer for an individual strategy session. That is our way of helping you get where you want to go and saying thank you for taking the time to join us. There's nothing to buy in these strategy sessions. What it is an opportunity to look specifically at your individual situation. The technology that we've harnessed over the last 12 months is fantastic in sharing all of the experience and knowledge that we at OpenCorp and the specialists that we bring in through these interviews as a way of increasing your knowledge base. What it doesn't do is help you understand specifically how you can take advantage of that, given that everyone's individual situation is different. So you can take a deep breath. There's nothing to sign, there's no cost, there's no obligation. It's purely just the next step in the process that allows you to be able to take the knowledge that you're learning today and understand how to apply it to your individual situation. There will be buttons within that email with a webinar replay that allow you to be able to select to be contacted and request that individual strategy session. Keep an eye out for that. But without further ado, we'll rip into the webinar today. I'm really looking forward to sharing the interview that I filmed about a week and a half ago with Tim Lawless. You'd have to be hiding under a rock to not be aware of the positive momentum in the property market, some of the near record levels of growth that we're seeing. And while I don't want to create short-term hype about property markets, because that's not what we're about here at OpenCorp, I do have a passion for helping people understand the fundamentals that drive market movements, as opposed to the headlines that are there to create hysteria. So it's not surprising that all the fundamentals are directly lining up with a positive housing market and future capital gains. But it's about understanding those fundamentals so that you can make smart decisions, not only in March 2021, but in 2022, in 2030, and 2040 even, as you're growing a portfolio that is effective over the long term to deliver the kind of goals and outcomes that you're after. For those of you that might have heard one of my business partners, Cam, talk on webinars and Facebook Live Q&A feeds with me, you'll know that he loves everyone to try and stump me. That's what we're building in today. Ask a question. Doesn't matter, there are no dumb questions, throw them in there, and that way we can make sure that we get the answers to you on the information that you're after. Just use the sidebar on your screen there. Okay, so in terms of what we're going to be covering today, 5 key points from the agenda. Clearly, the property markets are hot right now. Can they continue to accelerate? How long do we think this growth phase is going to go for? They were specific questions that I asked Tim in this interview. We're seeing distinct differences between the types of property or the different asset classes and which ones are working right now, which ones are super effective and which ones have some challenges. To be perfectly frank, there's a big difference between houses and units. We'll unpack that for you as well. There's a lot of talk in the media right now around government stimulus with regards to JobKeeper and JobSeeker ending at the end of this month. What's the impact of that going to be? I have to take my hat off to the government. I think state and federal governments, all things considered, around Australia have done an amazing job for Australians over the last 12 months. And regardless of your political preference, I think it's fair to say that everyone from a government perspective really stepped up to cushion Australia against some of the impacts of COVID. The unemployment rate is so much lower than what was anticipated or expected 12 months ago. The stimulus has been there. That lends itself to understanding what the government's motivations are on how they're going to deal with this budget deficit, and that creates a lot of opportunities for us as property investors. I drill into that with Tim specifically, and not just what the effect of JobKeeper and JobSeeker has been, but we've seen so many other types of stimulus in federal and state budgets around stamp duty discounts, around the home builder incentive, and so on. We'll also explore what that future roadmap looks like for ongoing government stimulus, because the handbrake is not going to be just pulled at the end of March, never to be seen again. There is a program there that Tim outlines. Next, banking reform. There's a lot of talk at the moment about and we've been quite open since October last year around the lending restrictions, the removal of those responsible lending laws, exactly what it means and the impacts. Since I interviewed Tim, we've seen an update where they've basically discussed it within Parliament. It's received broad approval for those changes to be passed through, and it requires the Senate to make a decision, which has been deferred to the second week of May. So still very much on the table. Tim will outline what he thinks will happen there. And then finally, everyone loves to look into the crystal ball that no one has. We use data to be able to do that, and that's what's underpinned our track record, which I'll elaborate on after the interview with Tim. Where does Tim see the markets? Where would he be investing? What's the outlook for different capital cities and different locations, given that we've got a national and even international audience with us today? That's what you're in store for over the next half an hour or so through my discussion with Tim. So let's kick it off. That's what we're going to be covering off. Enjoy the interview.
Hi and welcome. I'm Michael Beresford, the Director of Investment Services here at OpenCorp.
and thrilled to have a very special guest with us today. We've got Tim Lawless. Tim is the head of research for RP Data CoreLogic. He looks over everything Asia Pacific, so no better source to be going to be understanding around what's happening in the property markets today. Tim, welcome and welcome to OpenCorp.
Yeah, it's great to be here in person. It's quite a new phenomenon for me, Michael. So yeah, thanks for inviting me along.
No, you're welcome. We've been having a webinar series which you were part of last year. It was the middle of the year last year. It's got a very different climate that we were speaking in back then compared to now.
How times changed, hey? We're right in the middle of what's quite a spectacular boom in property prices at the moment.
Yeah, not unpredicted when our viewers that might have seen our interview last year, we were talking about a lot of the fundamentals that drive these things, and we talk about how upturns come after downturns and what might be driving that. I guess that's probably a good lead in. Can house prices continue to be accelerating, over the next 3 to 6 months and beyond? What are your views on that?
Well, I think at the moment it's clear we are seeing housing prices continuing to accelerate. In fact, I think when we report our March numbers in April, we probably will be reporting either record numbers for the rate of capital gain or very close to record numbers. Last month, we're reporting values nationally. We're growing at the fastest rate since 2003. And really broad-based as well. We're seeing pretty much every market around the country, be it capital cities or regional markets, are all showing values rising. So again, this is quite unique that we don't have any counter-cyclical markets at the moment. Values are rising pretty much everywhere, and they are accelerating. Gradually, you'd have to expect there will be some affordability constraints impacting on the market, especially in markets like, say, Sydney, where through March, we are going to see Sydney hit a new record high in housing values, recovering from the 2017 peak. And we know the city's already a relatively unaffordable market. So you'd have to think affordability will start to become a little bit more challenging for those people that aren't yet in the market.
Sure, and obviously low interest rates get a lot of airtime in the media. That's one that people would be aware of. But what are the factors that are driving this unprecedented, well, not unprecedented, but for the last 20 years, record levels of growth?
Yeah, well, rates are clearly at the heart of it. The mortgage rates are still falling, even though we haven't seen the cash rate move since October last year, when it hit 0.1%. We're still seeing mortgage rates coming down slightly month to month. It really highlights just how competitive the lending environment is at the moment. So you've got extremely low lending rates, but on top of that, you've also got this surge in consumer sentiment. We're seeing consumers or households feeling more confident now than they were before COVID-19 was even a thing. In fact, well above average. On top of that, we're also seeing the surge in demand, which is caused by such a strong sentiment reading, is running headlong into extraordinarily low supply levels. So we're not seeing many homes out there that are advertised for sale. That's starting to pick up a little bit now. So we're starting to see a rise in new listings coming on the market. But the rate of absorption is so fast, so strong, that overall supply levels remain extremely low, which, so for a lot of buyers, they are feeling this sense of urgency, or FOMO, as people talk about, is another factor that's adding to this upwards pressure on prices.
And are you seeing a similar thing in rents? Obviously, there are different asset classes that are affected differently. We've seen through COVID-19 a lot of double-digit vacancy rates in apartment buildings, for example. We deal in the suburban housing ring, very, very low vacancy rates and tightening. Is that same level of demand and lack of supply really driving that on the rents side as well?
It's even more diverse, in fact, in the rental market. As you say, we've got this real, I guess, this broad spectrum of rental market conditions. At one end, at the weakest end, you've got your inner city apartment market, which was already oversupplied leading into COVID-19, and now it's had this demand shock from overseas migration simply stopping. So if you think about inner city rental tenancies, a lot of that was underpinned by foreign students, temporary migration, which isn't going to start to shore up until we see international borders opening. But then at the other end of the spectrum, we've got detached housing, very strong rental markets, extremely tight vacancy rates, generally around the middle to outer ring suburbs. And then geographically, if you look at markets like, say, Perth or Darwin, southeast Queensland, all those markets are seeing vacancy rates extremely low. And in the case of Perth, we're seeing rents for houses rising at about 14% per annum at the moment. Units not quite as strong, but still up about 12% per annum. And this is at a time when rental moratoriums are still in place across WA. So they expire at the end of March, and arguably could even see stronger conditions after that.
Yeah, I had my Perth property manager on the phone late yesterday, and the rent's up for renewal in about 6 weeks' time. It's going to be a nice increase, let's just say. So, yeah, we're seeing. We talked about different asset classes just then. So I guess to expand on that, we've seen house volumes in terms of sales vastly outstripping unit sales. What's driving that, and why is that occurring?
Yeah, it's more than just volumes, it's values as well. So we're seeing a much stronger rate of appreciation for house values rather than unit values. So in terms of volumes, we're seeing, well, nationally, the number of home sales up to the end of February was tracking nearly 20% higher than the decade average. So we've really seen the number of home sales rebounding really quickly. Unit sales are rising as well, but they're still nearly 10% below the 10-year average. So it's pretty clear there is this demand shift away from density, probably not too unexpected during a global pandemic that people don't want to live in a high density situation. But I think there's probably more than that, in the sense that we're seeing more flexible working arrangements for a lot of people in particular industries, particularly knowledge-based industries, where they can work a little bit further or live a little bit further from where they normally work if they don't have to commute every day. That's also flowing through to the regional markets as well. Then on top of that, we're also seeing first home buyers are extremely active, and it looks like that demand profile from first home buyers is more skewed towards detached homes, particularly those middle and outer ring areas where first home buyers are looking for that sweet spot or a sweet point of housing prices where they're still affordable, but also offer up some level of desirability and livability.
For sure. Is that shift to detached housing and a bit more space and so forth, is that something, obviously it's come about as a result of COVID, is it something that you see as more of a fundamental shift long term in terms of how Australians live and work and kind of function on a daily basis?
So is it structural? It looks like it probably will be structural for at least a point in time. I think a big part of this shift of demand towards lower density housing can be explained by a more flexible working arrangement and the surge in first home buyers. But you'd have to expect that gradually, as prices become more unaffordable in those particular areas, either you'll find demand moves further out to the more affordable outer fringe areas, or it starts to, or maybe a bit of both, it starts to come back closer to the inner city but higher density areas. I don't think we're going to see demand bouncing back into high density quickly at all, but some of your medium density markets, townhomes, terraces, villas, that sort of medium ground makes a lot of sense, where people still have, the benefit of space, but they don't have, the affordability constraints they might be finding in some of the detached housing markets.
Yeah. You mentioned first home buyers a couple of times there. I guess, how much of that first home buyer activity do you think is being driven by the low interest rates and the affordability and the push to see the opportunity to get in? And how much of it is being driven by the stimulus that's there? Are they playing equal parts? How does that part play out for you?
I think a lot of this surge in first home buyer activity is very stimulus driven, and we've seen previous periods where there was a lot of stimulus on offer for first home buyers. Go back to say 2009 when the first home buyers grant boost was available. We saw what we call the vacuum effect. That demand gets sucked forward, and then as the stimulus starts to dissipate, you see levels move back to more normal levels. So chances are, as we start to see a lot of the first home buyer stimulus and the broader stimulus in the marketplace starting to dissipate, we probably will see first home buyer demand starting to taper off. It makes sense that will probably happen, particularly when we see things like, say, stamp duty exemptions or concessions in Victoria. I think they expire around the middle of the year. Home builder expires after March, for example. Not that that's specifically for first home buyers, but it's another just aggregation that they're using. But I think going forward, I'd be really surprised if first home buyers went back to their pre-stimulus levels, simply because interest rates are going to be remaining low for the foreseeable future.
Yeah. You mentioned quite a few different stimulus things there. I was keen to ask you what you thought, the removal of stimulus, especially JobKeeper, is coming up imminent, What are your views on the impact of that? How's that likely to play out and specifically in property markets?
It's definitely creating some uncertainty. And we think about the first fiscal cliff, if you will, which was at the end of September last year. That was the previous time we're seeing a lot of this government stimulus was phasing out. In fact, it was much more substantial at the end of September than it will be at the end of March. The difference between these two periods of fiscal stimulus phasing out is that after March, there won't be any of the additional income support that's left. So that's probably one of the key factors that really helped to streamline that period and say the December quarter last year, where despite the fact that JobKeeper was winding down and JobSeeker was starting to taper off as well, we still saw unemployment falling, we still saw job numbers rising. I think after March, we probably will see a temporary period where unemployment starts to maybe even rise a little bit, job numbers may actually start to fall a little bit. But I think when you consider the overall momentum in the economy, that will probably be quite short-lived. And then if you look at some of the other stimulus measures that are coming in to replace it, that are much more targeted, the tourism package, for example, that the federal government has recently announced, that's probably much more, I think, in tune with where the economy is at the moment. Those industries that are going to be quite challenged while international borders stay closed are still going to be benefiting from a lot of stimulus from the government, but the broader economy that's now well and truly on track to recover much earlier than anybody expected is going to be shoring up labour markets. But on top of all that, even though we are seeing all this fiscal support winding down, we still have interest rates remaining at their super low levels. So that's probably the key thing here, is that we still have some monetary support, monetary policy support for the economy, which I think will keep the housing market quite lively.
Yeah, it's been amazing how really as a country we've responded to it, and the governments likewise. I remember last year we talked about stimulus and the role that the governments had, to provide that, because they didn't have the lever of interest rates like they've had in the past. The RBA have obviously committed to the 0.1% cash rate, until inflation's back up in their target band. How do you see government stimulus kind of continuing to roll out? It feels like as one strategy kind of stops or comes to an end, they supplement it with something else that's more targeted around the industries that particularly need it. Clearly, it's been heavily focused on keeping the unemployment rate as low as possible and limiting that. We've seen a really strong rebound in the labour markets, as you say. How do you think the wider picture on stimulus will play out over the next 6 to 12 months and beyond?
Yeah, I think it's exactly as we're seeing it now, a very phased approach, and the government will obviously be watching the key metrics really closely for any signs of, say, distress coming back into the economy or a slowdown in the economic recovery trajectory. If that starts to happen, if we start to see unemployment rising over a sustained period or jobs growth starting to fail, obviously there's going to be a new round of stimulus that's being offered up to prop up the economy. We're still in a fairly fragile phase of this recovery, even though we've come out of a recession virtually unscathed. Maybe that's the wrong phrase, because we did see a massive downturn in GDP that was very temporary, but now we've seen a very swift recovery phase. It's very clear that even though we're out of a recession, there is still going to be some repair to the broader economy itself. So I think it's going to be in maintenance mode for some time, and any signs of sort of a stalling of the economic recovery, I think will be very quickly reacted to with additional support.
Yeah, excellent. One thing that we talk a lot about in our patch, obviously, is the impact of lending. Not only have interest rates come down, that's improved borrowing capacities, which has improved demand and underpinned a lot of this extra demand in the market that you talked about. There's imminent reform around banking that's been talked about, or Josh Frydenberg announced late last year. What are your views on the impact that will have, and more specifically, if they need to be keeping tabs on what's happening in the economy, how long will they kind of keep it? Will they let housing prices run for a bit? What's your view on how the lending reform picture will play out?
Yeah, there's a lot going on here that's it's probably a little bit murky, to be honest. So at the moment, we're in a situation where reforms to the Credit Act, which you asked about in the first part of your question, they still need to be debated in the political environment. chances are that could be watered down, maybe won't even get voted up. So reforms to the Credit Act are still highly uncertain. If they do get voted through exactly as the Treasurer suggested they would go through before the budget last year, it simply means that it doesn't necessarily mean it's becoming easier to get credit. It just means that process becomes more streamlined. There's some change to the regulatory sphere where ASIC becomes less involved in the oversight, APRA becomes more involved. Non-banks versus the banking sector, maybe some more similar rules around the playbook. But I think the more important area of the lending environment to watch is going to be lending standards and any signs of macro-prudential intervention. Big word, all macro-prudential means is we see the regulator coming in tightening credit rules because they become a little bit concerned about financial stability. So a few examples of that we saw back in late 2014 when there was a 10% speed limit applied to investment credit growth. Then again in 2017 it was more targeted around interest-only lending. We saw the market react, or the lending environment react virtually instantly to that, and it did slow the marketplace. So I think APRA will be very closely watching things like how many loans are being written on high debt-to-income ratios. 6 times if you're applying for a loan and the debt level is more than 6 times higher than your income, that's where it becomes a little bit harder to secure a really good interest rate, for example. They'll be looking at how many loans are being written on high loan-to-valuation ratios as well. So if you don't have a 20% deposit, it becomes a little bit harder, I think. So any sign that those metrics are starting to lift substantially, I think will be jumped on quite quickly with some credit tightening.
Yeah, I think it's a really good point that you make, and what we try to help our clients understand is that while interest rates have come down, it's still not an easy time to get money. You know, if we think back to pre-2017, you could get a 90% plus capped LMI, for example, so it was effectively a 92% loan. We haven't seen that in the marketplace for the last 4 years. So there's a common belief out there. It's easy to believe, based on everything that we hear, that banks will just throw money at anyone, especially when the property market's moving. It's clearly not the case. And one thing that gives me a lot of confidence as an investor is knowing that because it is difficult to get money, and there are these regulators and there are these watchdogs, if you like, on what's happening, it gives me a lot of confidence knowing that we're going to avoid a subprime type scenario that the US had, where it was much more of a free-for-all, and that any growth in house prices and any demand that we're seeing can be funded and people can afford it, and there are checks and balances around that process.
Yeah, I agree. It's certainly important that we do maintain lending standards, and any signs of that slippage, I think we can expect there will be some tightening coming through, and we're already seeing some economic commentators suggesting we could see that before the end of the year.
It's amazing, isn't it, the cycle of how things work? It's just one of the many variables. So, as you know, property is a long-term investment. That's how we like to focus on it. But yeah, I guess in terms of your relative short-term forecasts, in terms of what your numbers are telling you, and what we're seeing, where do you see the property market over the next 3 to 6 months?
Yeah, I mean, the next 3 to 6 months I think is easy. The market's accelerating, there's a lot of momentum here. I really can't see in the next 6 months the market starting to move into reverse. We might start to see the rate of growth peaking out. I talked a little bit about affordability through our session, and I think that'll probably be a natural break that starts to impact on the market, especially in the more expensive cities. But I think outside of that 6-month period, it becomes a lot less certain, of course. And I agree, property is always going to be a long-term prospect, not just because of the high transactional costs and so forth, but because a long-term hold helps you to get through any sort of cycles in the marketplace. My view longer term is we should expect housing values will continue to rise through 2021, probably well into 2022, supported by extremely low interest rates. After that, the fact that the RBA governor is very clear, we aren't going to see the cash rate rising until inflation's back up in the target range, which implies a much tighter labour market. It's going to be a long time before rates start to rise. Will it be 2024? Maybe a little bit earlier, depending on the trajectory of the economy. But I think the next couple of years, we're pretty safe that rates will stay very low.
Yeah, excellent. So to your point, Tim, just then around the RBA governor committing to a 0.1% cash rate until we start to see inflation picking up and so on. What's your view forward looking for the labour market, specifically the unemployment rate coming down, the rate that will happen, and what that means for wages growth, which obviously gets a lot of airtime in the media?
Absolutely. So I guess just to rewind a little bit, the Reserve Bank governor is very clear. They're not going to push the cash rate higher until inflation's back to 2 to 3%. What that really means is for inflation to rise, we need labour markets to tighten, and we need to see some wages growth coming through. That's probably a long way off, but we are expecting labour markets will gradually tighten. I did mention a bit earlier on, there could be some disruption after March as COVID, as the JobKeeper program winds out. You'd have to expect there are going to be some businesses that simply can't continue to keep their workers on. So there might be a bit of a blip there, but I think progressively we will see unemployment continuing to fall. Remember, at the moment it's around the mid-sixes. Really, to start to see wages growth coming through, you want unemployment to be down under 5%, maybe even getting closer to 4% based on some of the recent comments from the RBA. That's still a long way off. So I think we can expect labour markets will continue to tighten. We'll continue to see the unemployment rate coming down from above average levels down to more normal levels, but to really start seeing the wages growth picking up enough to drive inflation, that's probably still a couple of years away.
So just to cycle back, Tim, to something you mentioned earlier around Sydney hitting an unaffordability cap at some point in the future. How do you see the major capital city markets? If you could maybe just do a quick run around the horn, a couple of comments about each one and where you see those.
Yeah, okay, let's start in Brisbane. Brisbane's had a fairly weak historical cycle, so affordability is not really all that challenging in that market at all, especially when you look at some of the outer fringe areas, getting into outside the Brisbane local government area, getting to like Moreton in the north, Ipswich in the west, and down to Logan in the south. The Moreton Council area, for example, is one of the best performing regions of southeast Queensland, rivaling the Sunny and the Gold Coast. So very strong markets. I think that will continue, particularly on the basis that population growth is very rapid into southeast Queensland, particularly from interstate migration. Yep. Moving down to Sydney, Sydney is going to hit a new record high in values through March. It's already showing affordability constraints at that marketplace. Rental yields are at record lows. They're at 2.9% gross, which highlights that rental dynamic is a little bit out of kilter with the values in that marketplace. So I don't think Sydney's going to be as popular with investors as it has been in the past, but still, it's Australia's largest city. It's got a very vibrant economy. It's going to be a marketplace that still sees some growth, probably not as much as other markets. Melbourne, of course, nowhere near as high prices as what Sydney has, and incomes aren't all that much different. So it doesn't have the same affordability issues as what Sydney does, but Melbourne does have more exposure to overseas migration. Not a huge amount more than Sydney, but it is Australia's largest arrival point for overseas migrants. So opening up of international borders will have a strong impact on the Melbourne market, particularly the inner city areas, whereas the outer fringe markets still seem to be quite strong thanks to this shift towards detached housing options and lower density markets. Adelaide, also a really strong market. It's always been a very steady performer. We are seeing interstate migration is now sort of stabilising in that marketplace, finally moving into some positive territory. We are expecting values will continue to rise, but probably not be one of the top performers, probably won't be one of the bottom performers either. Perth, on the other hand, is looking like the market to watch to me. It's extremely affordable. We're still seeing housing values in Perth 16% lower than what they were when they peaked in 2014. So you're buying into that marketplace around $2,006. You've got rental yields, which are up around the 5.5% to 6% mark. Rental markets are extremely tight, and it's one of the only cities where yields are actually rising, not falling, due to the fact that rents are actually rising faster than values, which is quite profound when you consider values are rising really quickly. Darwin, the strongest market in Australia at the moment, but it's less diversified, a little bit more fickle. It comes out of a massive downturn. The values in Darwin are still about 25% lower than what they used to be. So yeah, probably some good investment opportunities there, but it's certainly a little bit more risky. And then you've got Tassie, which is also starting to see some affordability constraints. It's still relatively cheap to buy into, but for locals, a lot of them are simply priced out of the market. Probably continue to benefit from this lifestyle trend that we're seeing, particularly people coming out of the mainland. But yeah, you'd have to expect that a growth run that Hobart and some of the regional markets around Tassie is going to start to come to a standstill due to affordability.
Yeah, a great summary there. Just one question to finish. You mentioned overseas migration and specifically how Melbourne's been a major recipient of that. What's your view on, forward-looking, what the government strategy will be around overseas migration? Will it come back at the same levels, at greater levels, and so on? Obviously, there's a vaccine in play and a range of factors, but for the medium to long-term investors out there, can we be confident that net overseas migration will continue to be strong into the major capitals?
Yeah, I think the medium to long term, absolutely. And I think maybe even more so considering how well Australia has managed this pandemic. I think it makes Australia even more attractive for people to come to. It's an environment that has a fairly stable political environment, which is also really attractive to foreign buying coming into this marketplace. In terms of overseas migration, it's probably still going to be quite mild until we see more broader policies opening up international borders and a more global rollout of vaccines. I think it'll probably be a gradual rebound into population growth coming back to Australia based on bubbles that are established between different countries. The biggest recipient, I think, immediately will be foreign students. If we do start to see foreign student markets opening up, hopefully that will start to shore up some of these inner city rental markets that have been dealt an extreme blow through a massive demand shock.
Wonderful, Tim. Well, some fantastic insights there. Once again, thanks for joining us down here at our Open Corp headquarters. Been great to catch up face to face. Glad we can do it rather than Zoom like we did last year. Nice to see you. Thanks.
So there we have it. What's fantastic insights from such a knowledgeable source around all the fundamentals that really drive the Australian property market. As you know, we like to give as much as possible here at Open Corp. So as I say to all my clients, and the Open Corp clients will know, I'll give you a little bit of free insight. At the start of COVID, we did a 15-minute video each week for the first 8 weeks, helping our clients understand and put into context all of the uncertainty that was in the general media. While it's great that everything that we said would happen did happen, there's a very good reason for that. And firstly, we've been through a few downturns over our long-term journey. It's not always beer and skittles. The second thing is what we focus on 100% are the 6 fundamentals that drive property markets. So this will help all of you, get a pen ready. This will help all of you be able to put what you're reading in the media into context and understand, is what I'm reading related and how is it related to these 6 fundamentals? Now, the 6 fundamentals aren't these key takeaways from Tim. I'll get to that in a second, but write these things down. The 6 fundamentals that drive property markets are supply, demand, jobs, affordability, government infrastructure spend and stimulus, and number 6 is lending policies. So given that we've been through that, it's probably no secret now, the line of questioning I was taking Tim through, all of the questions were focused around those 6 things and their impact on property markets moving forward. So the key takeaways, as we were saying, the numbers reported in February were clearly, record rates of growth, the fastest growth that we've seen since 2003 in nearly 20 years. That hasn't been isolated to one market or another. It's been across the board. And the other thing is, Tim was saying in the March numbers, which are due to come out in the near future, he expects that Sydney will be seeing a record median house price. Now, I just want to touch on that point very quickly. I'll take you through what our property selection process is and how we identify the areas that we want to be in at any point in time. Now, when we talk to people, there's often some feedback around, well, Sydney's moving really strongly. Why wouldn't you look at the Sydney market? And Tim's point around that record median house price only being reported in March is significant, because basically what it means is all of this record month-on-month growth that we've seen for the last few months is really only playing catch up to the correction that happened after the 2017 peak. Okay, so we need to take it in full context. The Sydney market saw a 94% increase in the median house price between 2013 to 2017. It saw a minor correction That growth has basically made up that correction, but there's still an affordability cap in Sydney. So there are a lot of questions that came through prior to the webinar around would we be looking at Sydney, what the growth outlook looks like for Sydney, etc. So I thought I'd just share that tidbit and make it, draw the link for you based on the feedback that Tim had. Okay, governments will approach stimulus into the future in a targeted and specific manner. So up until now, there's been broad brush stimulus. Tim was very clear that stimulus would continue to be provided if required, so that we can continue to build on the excellent recovery that we've had in Australia, but it will be more targeted and specific. And since we had that interview, you know, we've seen things like the half-price flights into certain areas of Australia that are supporting the tourism industry. He talked a lot about vacancy rates specifically and the fact that we saw tightening in what I call the family belt. So the middle to outer ring areas, detached housing, a massive influx of demand without a lot of supply coming onto the market has seen vacancy rates come down dramatically in many of those suburbs in most of the Australian capital cities. It's definitely not isolated to one or two. To show you why we look at low vacancy rates specifically, for those of you that have been following OpenCorp, you'll know that we take a capital and compound growth focus to our investment strategy. But with that said, we don't feel that you have to sacrifice cash flow to get the superior capital growth. We feel that you can have both of those, the best of both worlds, if you like. And the reason why we look at low vacancy rates is because as the vacancy rate comes down, based on supply and demand, we see an increase in rents and quite often a rapid increase. For example, clients of ours that were taking our advice by buying pre-recovery middle of last year, you know, we were looking at a rental forecasts of $460 to $470 per week. We've had 4 clients sign leases at between $530 and $550 a week in the last month. Okay, so that's just an example for you. We're not talking about $5 or $10 differences here, dramatic increases in rent based on vacancy rates coming down, which is basically supply and demand of work from a rental perspective as opposed to a capital growth perspective. Tim talked about lending reform. That's the general classification for the lending legislation around the removal of the responsible lending laws. And more appropriately, I guess, the lending standards, as Tim called them. The lending reform will basically map out the larger pathway that the government has for lending policy moving forward. The lending standards are going to be more agile, short-term regulator-imposed restrictions, if needed, to ensure that the property market doesn't run out of control. Okay. One thing that I just want to point out at this point, we got a lot of questions about this as well. I get asked about this every day. You know, Michael, when's the boom going to bust? Well, I think what's important to understand is that the restrictions that were put on borrowing capacities are still in place. Even if the responsible lending laws are removed, as Tim said, that's only going to streamline the approval process, which will improve credit flow, which is fundamental to our economic recovery. It's not going to mean that you can just walk into a bank and get $2 million because, you know, you don't have a job. There are still checks and balances and criteria that must, you know, be fulfilled to be able to borrow money. So at any point in time, whatever the house prices are, we know that anyone borrowing money can not only support those repayments, but can support them with a buffer on higher interest rates. So that's what gives us a lot of comfort. Again, look at the process that's being applied here. Yeah, $1 million for a house sounds like a lot. I get it. You know, my mum and dad bought their property for under 100 grand in 1980. That's what happens over time. That's why we invest in property, because it goes up. Right? If we were still talking about property prices being the same as what they were 10 years ago, it'd be a pretty lousy investment. Okay, so what we need to do is understand what is driving that and how it is controlled so that we can reduce our risk. Some really key points around lending and why we focused a lot on it in the interview with Tim. He talked about house price growth being at a rapid rate. Again, makes it sound like a boom when you put a headline around it. The fundamentals are that, that we're effectively sitting on the best part of 12 months of pent-up demand. Okay, and at any point, when you imagine that you shut the supermarkets for 12 months, right, or you're going to shut the supermarkets for a week, everyone turns up for toilet paper. No surprise that there's a rapid increase in demand in a very short space of time. This is no different, it's just in housing. Okay, so remember what happened in 2003, right? To provide some context, between 1997 and 1999, we had the Asian financial crisis. That meant that international stock markets lost 60% of their value. So that meant that there was a push into housing. September 11 happened in 2001, just before that. So there had been a period of disruption and a relative period of less activity in the property market. Once that had settled down, fast forward to 2003, there was that pent-up demand that came into market. So again, look at the fundamentals that are driving these things to understand why they happen, as opposed to just thinking that record house prices are a bad thing and they just happen because today is Wednesday and that's what they choose to do. There are always underlying factors that drive these things. And finally, again, we've talked a fair bit about short-term impacts here, both in the last 12 months, and we asked Tim for his views on the next 6 months. Property is a long-term proposition. And fundamentally, when we look at those 6 things, we look at the labour market, we look at unemployment rates coming down, we talked a lot about affordability, lending, government stimulus, but fundamentally supply and demand in the major capital cities where we want to be investing, that's what gives us the confidence around future growth and why property still makes sense. So 6 really key points to take away there from the interview with Tim. I really enjoyed the chat. I followed him for a long time. It was great to be able to meet him face to face and have him down at Open Corp headquarters here in Melbourne. I hope you got some value out of that. Again, quick reminder, try and stump me, send through some questions. You've got the question bar on the side of your system there. Put them in. Abby is collating them rapidly in the background, and she'll be firing them through to me at the end of the webinar. So a lot of questions also said, well, exactly what do Open Corp do and how can you help us, So I'm definitely not going to dwell on this in detail. I am just going to cover it very quickly for you. The way that I explain it to clients is we can do everything for you except bring the money and the motivation. That's on you guys, okay? But if you are time poor, knowledge poor, or want a full outsourced model, then that's exactly what we can do. Investment property selection is a pretty important part of your property investment portfolio working for you. Our point of difference is that we have a research and analytics team headed up by my business partner and long-term friend, Matt Lewison, that looks at all of our criteria, which I'll take you through next, and identifies the locations around Australia where we want to be looking. So we're not just looking in one capital city, we're not just looking in one area, we're looking at any of the areas that fulfill all of our criteria and our map selection process. We have data analysts, we have ex-valuers. This is the kind of powerhouse of property expertise that you have behind you to be able to make sure that you're getting the best possible results, and that's what's underpinned the Open Corp track record of outperforming the market considerably, which I'll show you in a second. In addition to that, for those of you that have maybe seen one of our or more of our 300 WODs online or been following our webinars, I'm really big on making sure that you get your finance structured the right way. In short, the way that most brokers and banks want to set it up and the way that we need it set up to be able to build a portfolio are polar opposites. We've got that expertise in-house to ensure that you keep your own home safe and you're maximising the control around your portfolio. No one wants to be fixing toilets at 2 o'clock on a Saturday morning. Okay, we have a property management team that takes care of all of the ongoing management of the property, so it's as stress-free as possible. You go about living your life, we do what we do best, and we manage that for you ongoing. But fundamentally, if we look at the numbers, only 10% of Australians invest in property. Okay? Most are retiring on the pension. I figure you're part of the 10%. That's probably why you're tuning in today, which is great. When we look at those 10% that invest in property, 70% of them only have one investment. And funnily enough, 68% of investors buy in the same postcode that they live in, according to the ATO. Okay. So buying around the corner from where you live and getting emotional about the investments that you want to buy is not a formula for being able to achieve the financial goals that you want. What is a formula is understanding how you can leverage from one property into the next and into the next and into the next to be able to build a small but effective portfolio over the medium to long term. It doesn't all happen in the first 6 weeks, and I don't have the Tats Lotto numbers for you guys. I'm sorry, it's not a get rich quick formula. Okay, it takes time to work, but compound growth is the reason why most of the BRW rich list have grey hair, because they've just been doing it for longer than what I have. In order to be able to help you over that journey, achieve the goals that you want over the long term, you need to be keeping your finger on the pulse at regular intervals. And that's effectively what our Mentor for Life program is about. We streamline the process where we are continually educating you step by step. The way that I explain it is it's impossible to pass Year 12 maths on the first afternoon of prep, right? Nothing can be perfect, nothing can be well understood. There's a leap of faith to get started. I took it once, I was nervous. I understand what it's like being a first-time investor. For all those people that, that 32% of you that said that you're looking to get started in the property market, there's a leap of faith there. Take a long-term view, okay? We hold your hand throughout, start to finish, but most importantly, you can see at the bottom there, strategic portfolio management is around that hand-holding and that finger on the pulse in consistent intervals to make sure that you're getting where you want to go over the long term. So that's what we do at OpenCorp. That's how we help hand-holding end to end to make sure that you're tracking towards where you want to get to. Okay. I understand that long-term relationships sound cliche. Absolutely they do. But the fact that half of our business each year since we started has been repeat clientele and then telling people about who we are and what we do, introducing them to OpenCorp, A, makes us very proud, and B, it keeps us accountable against what we're delivering for our clients and the results that we're getting. So those results, how do we get them? We apply this formula to identify all of the properties that we invest in. Now, when I say that, that's not just all of the properties that our clients invest in. This map process that I'll take you through is exactly what I've applied, what Matt, Al, and Cam have applied, and our employees have used to add the properties to their portfolio and build the portfolios that they have. We call it the map process because it's a 3-step process of elimination that starts with capital city markets. Okay. Now, there's a 15+ data brief with a whole bunch of detail and percentages and stuff from the guys in the analytics team. But in short, there are some key things that we look at, and you can see them on the screen there. No surprise that supply and demand is at the top. We look at the market cycles, we look at the macroeconomic factors, we look at which of the markets are yet to see growth depending on the median house price potential. In short, we're looking at those 6 things that I talked about earlier. Those fundamentals, if you missed them, here's another opportunity: supply, demand, jobs, affordability, government infrastructure spend and stimulus, and lending policies. They are the 6 fundamentals that we're looking at driving markets. Once we have eliminated the markets that we don't want to be in, then we drill down into the suburbs, growth corridors, principal activity centres, and so on, that are the areas that we want to be in based on, funnily enough, all of the items above in market. Have you noticed how we haven't started to look at the property yet and how nice the white picket fence is or the colour of the tiles might be? There are some fundamentals that we need to focus on and a formula that we apply. To be perfectly frank, I don't love my investment properties. I absolutely love the financial outcome that they've given me and my family, but they are low cost to hold building blocks that give me compound growth. Love where you live or love where you rent, right? You don't necessarily need to love the investments that you're acquiring. They're fit for purpose and they're there to optimize the return on investment. Given that supply and demand is such a key focus, then infill areas are what we're looking at. And that means that we're looking at established suburbs surrounded by existing housing. So as Tim said, even though there's a movement out to the middle and outer ring, we're not looking out on the outskirts where there's abundances of land supply, because that just doesn't give us enough upward pressure based on where demand is at. As Tim said, you know, the supply levels on market can increase, and they have increased in recent months, but given the levels where the demand is at, then that supply is being absorbed quickly. So it's important to understand supply in context of demand. It's just not the absolute supply level on market that is important there. Amenities, everyone talks about those. They're pretty obvious: school, shops, public transport, recreation. Throw jobs in there as well. Okay. And then finally, the reason why I want to talk about abundant owner occupiers is because over 15 years of helping people with investments, I think the biggest concern that most people have got when starting out is the fact that what if they don't have a tenant? And that's why they tend to buy around the corner from where they live, because the easiest way to satisfy that concern is to drive past the property every day. I don't know a property that goes up in value any quicker if we drive past it every day. So what we want is a formula and a process to reduce our vacancy risk. And the way that we do that is ensuring that we've just got limited supply of rentals, and we're in areas where the majority of housing is owner occupied. Clearly, that's going to have appeal from a lifestyle and an amenity perspective because people have chosen to live there. It's a good sense of community. It's relatively safe. Okay. That's going to attract the kind of tenants that we want, the stable kind of tenants, okay? Especially into these suburban homes, detached homes that Tim talked about, where we've got land content to give us the capital growth component, and we've always got rental income coming in to be able to ensure that these properties are not costing us anything to hold. Once we've got the market and then the area worked out, then it comes down to the specific property. And two key points here: design guidelines and optimum size and quality. Design guidelines are simply the quality control measures to make sure that someone can't put a red house with a brown roof and a yellow door next to your expensive property. There's quality control in terms of the housing in any particular area so that that standard of property is well maintained nearby. That's important because the valuers are looking at comparable sales near your property to determine what it's worth and show any equity uplift over time. I could talk about optimum size and quality for probably 45 minutes and draw some pictures and take you through that. The way that I'll summarize it for you though is that we want any property to be optimal from a return on investment perspective. Now, if we can save $50 a week in holding costs, that might not seem like a big deal. But if $50 a week is the worst case in terms of what it costs you to hold a well-chosen investment property, which is exactly the situation with our strategy, if you're saving $50 a week, over time, you could hold 2 properties for every 1 property that's inefficient for the same amount of cash flow. So just think about if you'd bought 2 properties 15 years ago compared to 1, how much extra that would have made you through to today. So it really does make a massive difference. And basically what it's about is how you can spend as little as possible to receive as much income as possible. Now, that doesn't mean that the properties need to be small and boxy nor cheap and nasty, far from it. They have to appeal to tenants for us to have tenants in the property long term. But we just don't need to be over-capitalizing and spending more than what's necessary to bring in the same amount of rent. So very, very quickly, that is the MAP process. For those of you that have read Cam's book, My 4-Year-Old The Property Investor, he goes into it in a lot of detail, and my team can share with you in those free strategy sessions some more detail around all of the criteria and how we go about selecting the investments that we do. As I said, we're very proud of the MAP process because it's delivered great results for us and our clients over time. We had to make a submission to ASIC as part of our AFSL, as part of another division of the Open Corp Group. We had to show what the track record had been through the 10 years up until a couple of years ago. If we look at the performance across the Australian capital cities on average, that total return had been 6.8%, sorry, 6.2%. If we look at the Open Court results, 10.8% was what we managed to achieve in the same time frame. So we don't have a crystal ball moving forward. We haven't had a crystal ball historically, but what we do have is a pretty successful recipe called the MAP process around the results that it gets and making sure that we're buying into the right markets at the right time to maximize the capital growth, and now allow you to be able to use that growth to duplicate into the next property and start to become one of the fraction of the Australian population that can get past one investment to build a portfolio that actually allows you to leave the pension behind, create the financial goals that you're after, and live the lifestyle that you want later in life or in retirement, whatever is important to you. Okay, so if you're sitting there, again, part of that 32% who are looking to get started on your journey, okay, resist the temptation to buy around the corner from where you live. Use a proven process that gets results and mitigates the risk in the process. The outcomes will be far better. Whether you choose to use Open Court for that or not, please follow the MAP process. All the detail is in Cam's book. So based on everything that we've been through, there's an opportunity here to make a really, really smart decision. Now, I'm not the pressure guy. It's not how we roll here. We're giving you all the data and the detail and the information about why it makes sense. You've got a choice to make. As I said, it's around the money and the motivation on your behalf. There are a couple of things that you can decide. Will it be a case of history where you've thought about it, maybe been put off, etc., only to get 10 years down the track and wish you'd done something in 2021? Or is 2021 and all the information that Tim's outlined and Nerida outlined last month and the formula that I've shared with you enough to help you have the confidence to take that first step or that next step in building your portfolio to be able to turbocharge the results that you get in 15 years from now? I know 15 years from now sounds like a long way away. I remember buying my first investment property like it was yesterday, and that was nearly 20 years ago. Time moves pretty quickly. Make time work for you. And the one thing that I would say around this decision-making process is something that we've learned from history. We had a lot of clients as the market was moving through 2016 and 2017, think that, oh, that's okay, I'll get around to it next month. They didn't prioritize looking at their portfolio. They didn't prioritize taking positive steps towards their financial goals. And then almost without notice, 3 days after the announcement happened, the lending restrictions were tightened, and we had tens of clients that wanted to be able to duplicate and realized that they just put it off, but were unable to get the borrowing capacity, get the money from the bank effectively. And they've been sitting on the sidelines, some of them still today, some of them, were on the bench for 1, 2, 3 years. Take the lesson from what Tim Lawless talked about with regards to these lending standards. Okay, if you have the borrowing capacity today, do not wait, because there's every likelihood, if the market continues to be strong and you procrastinate, that the regulators will come in, regardless of the lending reforms changing, and saying, we're going to cap LVRs to a certain percentage, or we're going to only allow X% of a bank's loan book to be interest-only loans. Now, once those announcements happen, it might be too late. But remember that those changes are only going to happen if the growth in the property market requires it. So why not be in the market and take advantage of that growth and know that you've done whatever you can right now to be able to take positive steps to building your portfolio, because we don't know what's around the corner. And if these lending regulators present challenges to us from a borrowing capacity perspective, it doesn't matter what the cash rate is and how long the Reserve Bank of Australia have committed to a record low cash rate. If you can't get the money from the bank, we're sitting on the sidelines and we're not going anywhere. So there we have it, guys. We've got a little bit over time, but we like to pack in as much value as possible here at Open Corp. I hope you enjoyed the interview I had with Tim Lawless. I hope you found the information afterwards to be really, really helpful. I'm going to hang around now for Q&A, but just while Abby is jumping on, about to fire questions at me, I'd just like to say thanks for joining us. I hope you enjoyed it, and keep an eye out for next month's webinar, where we're going to be looking at the selection formula, not the selection process or the criteria, but how we actually get down to distilling what is a good investment. Okay, we're going to be going through that. Cam's going to be joining me, so you can fire some questions at him as well. Okay, Abby, let's take some questions.
Hi, good afternoon, boys. What a great presentation so far. We've had hundreds of questions come through, so I'll do my best to get through as many as we can. The first one is from Melissa. She's just saying prices are so high. Is it a good time to buy at the moment?
Yeah, great question, and definitely one that we get a lot. So thanks, Alyssa, for writing in. I think I've probably covered that in the core of the presentation, where I said that property prices go up over time. That's what we want. If we weren't seeing that, then it wouldn't be a great investment for us. I think the part that I can add to that answer is that remember that there are different fundamentals that drive the markets at any point in time. Go back to those 6 things that I've been through a couple of times, and really when we look at it, if you're not going to be seeing ongoing price growth in Sydney because it's been through a major growth cycle in recent times. But there are other markets there that haven't seen the same amount of growth, that are really well primed based on strong labour markets, based on affordability. We talked about the lending policies and record low interest rates. Tim Lawless talked about how that will drive demand. Every week I talk to people that say things like, oh, if only I bought that property 10 years ago. Maybe try and remember this. If I'd asked you 35 years ago, well, if you could have bought a property 35 years ago with the benefit of hindsight, virtual show of hands, I'm pretty sure everyone would say that they would. But if I'd said to you 35 years ago, before you bought that property, that there would be disruptions in the marketplace, like negative gearing being removed, like negative gearing coming back, like the recession, like the GFC, like September 11, the Asian financial crisis, etc., the number of people willing to buy 35 years ago would have shrunk dramatically. So the upside here is that we're not looking to get rich in the next 2 weeks. We're looking to identify a long-term growth asset that won't cost us anything to hold and won't impact our lifestyle in the process. And then as that property grows in value, it's worked for you, maybe add another one or another one to the portfolio as well. So absolutely never too late to start. Don't look back, only look forward. But we've seen a couple of months of rapid activity. That doesn't constitute a boom by any stretch. I'll share a personal example. I kind of got frustrated for 5 minutes back in 2016 when I'd had to buy a property that was about 40K more expensive than what the equivalent properties were 3 months before that. And then I kind of beat myself up and I said, well, what do you talk to your clients about? That property has grown nearly 200,000 since I bought it. So if I got hung up on the fact that I'd missed out on 40K and had to pay 40K more, I wouldn't have made the other 200. So buy now, hold for the long term, mitigate your risk is a good formula. Great question.
Thanks, Boz. We've got one here from Liliana. I think it's going to be a bit of a stump one for you. She'd like to know, how do you reasonably estimate value in a market where properties sell up to 50% above recent historical figures?
Sure. Great question, Liliana. So the way that properties are valued, there are 2 ways. Effectively, if you are buying and selling, then the market determines what property's worth. So when you say where properties are selling 50% above, I imagine that that's influx of demand, competition at auctions, for example, and prices being elevated. Now, we ideally are not looking to sell our properties, or at least the majority of investors are not looking to sell their properties. So the way that we need to understand value is based on a bank valuation and the way that a valuer operates. Now, when a valuer puts a property value on your property, the process that they go through is they look for what we call comparable sales, which are similar properties in terms of land size, number of bedrooms, features, age, etc. And they look at what's sold in the area, and then that determines the price that they put on it. They'll always be slightly conservative because banks like their buffer, just like prudent investors. but that's the process that's going through. So regardless of what you're seeing with regards to comparable sales, if you own a property in an area where there are properties selling for what you think are ridiculously high prices, that is an absolute opportunity to get your property revalued, extract that equity, and get into your next one from there.
Great, Buzz. We've got another question here. Sorry, there was a little bit of a delay there. We've got another question here from Andrew. I think it's a topic that you'll like to talk about. He would like to know, how long will these current low interest rates last?
Excellent, Andrew. I think Tim probably covered that. I'll give a quick recap. So Tim said that he expects that the low interest rate environment will extend through probably to 2024. The RBA have committed to not moving the cash rate until we start to see inflation back in that band of 2 to 3%, which is their target range. That will only happen once we start to see the unemployment rate come down further and wage growth and economic growth starting to increase.
Perfect, thank you very much. There's also another good one here. Why is it impossible to find a really good mortgage broker who can think outside of the box? So this is from Elisa. I'm sure you've got some good insights to share with that.
Yeah, it's a great question, Elisa. So mortgage brokers are heavily governed by the National Consumer Credit Protection Code. And so in English, basically, there's a series of strict guidelines that they need to operate within to ensure that the consumers are protected. Okay, so this is to prevent things that have happened in the past. You might remember a whole bunch of CBA brokers were basically falsifying documents to get people a loan to meet certain targets. That's why these things are brought in and why the mortgage brokers, what the mortgage brokers need to operate within in terms of guidelines. So with that said, brokers that have an open mind are really about understanding each client's situation and then identifying banks and lending policies that are best suited to those typical or that particular client circumstance. So I don't think it's a case of brokers thinking, with an open mind per se. I think really where the expertise comes in is their ability to look at a range of lenders. Even though nearly every broker will say they have access to 35 to 40 lenders, most brokers operate in a fairly narrow environment where there are 3 or 4 lenders that they put their majority of the stuff through. If that's an owner-occupied loan with an offset account and an interest rate, a low interest rate, for example, for 2 PAYG applicants, that's a pretty vanilla loan, and that will work with these 3 or 4 lenders that they have great relationships with. Okay, especially where investment's concerned, as you build your portfolio, you need to cast a wider net. And that's part of the reason why we work with investment specialist brokers, both in-house and externally, that are able to get those kind of outcomes for our clients and get approvals where clients, other brokers have not been able to. So I think it's really about understanding how investment lending is different and what you need and the lenders that are most suited to that. It takes a little bit more time and effort, right? But maybe that's what those brokers aren't willing to do at the same level.
Great, thanks, Buzz. One more here from Miriam, who I'm sure it's a question that we all want the answer to. How to shortcut paying off all loans? So what she's referring to is if you don't have big chunks of spare money to throw into a loan.
Awesome. If I had 10 minutes, I'll be able to walk you through it step by step, Miriam. So what I'd recommend, jump across to our YouTube channel, just type in OpenCorp, pay off your own home in 10 years or something to that effect. And we'll map out how you can effectively use next to no cash flow out of your pocket to hold growth assets that you can then use to reduce debt. The executive summary is that well-chosen properties that you hold over a 10 to 15 year period can basically mean that you pay your house off in a half to a third the time as what it would be using monthly cash flow out of your pocket to pay off a P&I loan.
Great, thanks, Boz. We have a question here from Paul, who says, will there be a change in the trend from moving to outer suburbs and regional centres back to the city at some point, or potentially even to units? If so, and when?
Great question, Paul. So I was looking at some data on this just in the last couple of weeks. There's a lot of media talk, given COVID, obviously, about a lot of people, moving for sea change and tree change. The data is this: people are moving out of capital cities every year. It's not like it just started to happen in the last 12 months. And when we look at the population of the major capital cities in Australia, that's 17 million, as a proportion of about 25 million or so total Australian population. Now, only 5,000 more people moved out of the major capital cities to regional areas last year than they did the year before, and the year before that, and the year before that. So effectively 5,000 extra out of 17 million, I think from memory is about 0.03%. Okay, so it's great for a story. It gets people thinking about moving beyond, but we've just seen with people starting to come to the office, those people that bought properties on a fairly impulsive nature 6 to 12 months ago are starting to wonder whether or not that was the best decision, and whether or not they're going to be using that property long term. So yeah, definitely not something that's out of the box, and definitely not something that's as dramatic as what the widespread media would have you believe.
Great, thanks, Boz. We've got one here come from Zian. He'd like to know, is it better to pay off your own home prior to starting the investment journey?
Okay, so that one's going to be fairly dependent on your personal situation, cash flow, the amount of debt, and so on. Speaking generally, what I would say is, if you've got enough equity in your property to be building the portfolio, then you shouldn't wait to have your own home paid off to do that. You should start when you can. As part of that finance structure that I talked about, and making sure you've got things set up the right way, there are simple but effective ways that you can extract equity from either your own home or a previous investment property without the mortgage repayment going up. So if you're worried or motivated about paying down the owner-occupied portion of the debt, then you can still access that equity. The interest on that equity is tax deductible, and the rent and the tax benefits from the investment property cover the repayments on that equity loan. So yeah, let's say that you've got a mortgage of 500K, and let's say that you're looking to take out 100,000 of equity. Please don't think that your mortgage goes up to 600, because it doesn't if you get it set up the right way.
Okay, so the next question here is from Kevin. He just wants to know, are interest-only loans still a viable investment option?
Hey Kevin, thanks for joining us. Absolutely, yeah. So interest-only loans were a bit more difficult to get back in early 2017. They're back in full swing now. Multiple lenders with 80 or 90% interest-only options. That's definitely the best way to go for most investors. Perfect.
We've got our question here from Gotta Leave. She'd like to know whether it's best to invest in new properties or to renovate properties.
Cool. So there's a few moving parts to that as well. If you've got a particular skill set, let's say you're a builder or a carpenter or something like that, and you can save on labour costs, then the profits, etc., through renovation are worth considering. The downside to that, though, is that you're typically going to be doing that renovation project, within a few kilometres of where you live. Otherwise, the travel time is just impossible to make that kind of project work. So, and if you're using external teams of people and trades, then it's very hard to make the financials work unless you get lucky with the timing and the market movements between when you buy the property, when you improve it, and when you sell it, or rent it out. Definitely, new property makes a lot of sense for a lot of reasons. The reasons for that, basically there are 5 key benefits to building new. The first is that you can maximize the rental income and the rental appeal and maximize the tax benefits through depreciation. Now, why I like new is because if that means that I'm getting more rent and more tax benefits, it's costing me less. So if I can have each property costing me less, I can hold a bigger portfolio for the same amount of cash flow than holding older properties that are costing me a lot more out of my pocket. So that means that I get a much better compound growth outcome, coupled with the fact that you can reduce the money spent on stamp duty, which is not tax deductible. I can ensure that I'm getting exactly what I want in terms of a floor plan that is optimum size and quality. And I'm also minimizing my maintenance risk, which is a really big risk mitigation factor.
Great. Thank you, Boz. We've got one here from Sunny who would like to know, how can an average family climb up the property ladder? So just someone just earning an average income, how can they get started and build a property portfolio?
Awesome. So the fact that that's the nature of the question tells me that you tick the box on motivation and mindset, which is unreal, Sunny. So keep at it. The best thing that you can be doing if you've got your existing home, you can be keeping your finger on the pulse with regards to what's selling around the area where you live. And when you're seeing sales that are higher than your property, understanding how much available equity might be there. The great thing, as I said before, is that capital growth focused property doesn't have to come at the expense of costing you a lot of money out of your pocket. 95% of the properties that we recommend for our clients are well and truly cash flow positive from day one. So what that means is it doesn't cost you anything to hold out of your pocket. The rents plus the tax benefits cover all of the holding costs, like the loan interest, the rates, the insurance, the property management, absolutely everything. Okay, so picking properties that are low cost to hold but having a growth focus is going to be a key part. If you are saving your deposit, do a budget, delay gratification, as Cam talks about. Do whatever you can to get that first deposit ready. The first property is the hardest one to buy for that reason. It gets easier once you've got that first one. And look, have a chat to our team when they get in touch with you, or again, request that individual strategy session, because then we can look at your individual situation and give you specific guidance. But there are things that you can look at, like investing with someone else, or equity gifts, or guarantor type scenarios that may or may not be relevant for your situation as well. I know we've had heaps, Abby. I'm just mindful of, we're nearly half an hour into Q&A. There have been so many questions to get through, which is great. Just to let everyone know, in that email coming out shortly, which I did mention, that strategy session request is an opportunity to talk to one of our team and understand exactly, what it means for your situation, and they'll have the questions that you've asked as well. So when they're talking to you, if we haven't been able to address your question today, given the volume of them that have come through, and thanks for sending them through, obviously, to everyone, we'll be able to get you the information that you need.
Absolutely. We're getting a lot of questions and a lot of very specific questions. So just trying to pick and choose the ones that are most suitable to the whole group. Obviously, if you do have a specific question, a strategy session would be the best option. I have a question here from Christine. She'd like to know investing versus putting that money into superannuation. Getting your thoughts on that.
Yeah, great, Christine. Now, this has definitely got a degree of your personal situation as well. It would depend on how much exposure you have to property already, how much you have in super, where that super is invested, what it's getting you, and so forth. So I'll talk generally. The issue with super is that there's no, I shouldn't say that. The downside to super relative to investing in property is that there's no leverage. And if you decide to take out a loan to buy a property within your super fund, then there are some differences between buying in your super fund and buying outside of super. So very quickly, the tax environment is different. It's a 15% rate versus your marginal tax rate. So you're getting less back in tax. Secondly, you can't duplicate. So you have to build up a higher deposit, typically 30%. You have to have residual funds in your super fund for liquidity of a 5 to 10% value of the property you're buying. Okay, so there are different, and interest rates are higher. So I'm not saying that buying property in your super fund can't work. Absolutely it can. It can make sense depending on the size of your super fund and the size of your portfolio outside of super. But it's just not apples for apples in terms of borrowing and buying in your own name. So the main thing is, if you're able to put $100,000 worth of money in super into an investment, and you make, let's say round numbers for ease, 10% per annum on that money, then in year one, you've made $10,000 profit. Because of the power of leverage, i.e. bank loans and borrowing, if you put $100,000 in and that goes with a $500,000 loan to hold a $600,000 property, and that goes up by 10%, then the return on your 100K is actually 60,000 in value as opposed to 10,000 in super. So that's why leverage and debt specifically is really powerful. But when we've got, it's important to understand the difference between good debt and bad debt, because most people are debt averse because, you know, everyone talks about have your own home paid off as quickly as possible. That's true, because with your own home, every single dollar on principal and interest is coming out of your pocket post-tax. I love having investment debt because I get a $30,000 to $35,000 pay rise from each property in the form of rental income and tax benefits that I'm not getting today that covers all of those holding costs as well. So provided I've got income to pay the interest and the other costs, investment debt doesn't worry me. So that's where leverage can be particularly powerful with property. But that's absolutely a strategy session question. Run that past the team and we'll happily give you some personalized guidance based on your situation and specifics. Well, there we have it. Thanks for all of your help today. Abby and her team put this on. So I really enjoyed talking to Tim. Hopefully all of our audience have really enjoyed the content. Thanks again for joining us this month, you know, for Behind the Numbers, what's really happening in the property market. And we look forward to seeing you next month, where we're going to be going through exactly that side-by-side assessment criteria on how we identify the right properties. Cam and I will look forward to seeing you then. Take care and take action. We'll see you next month. Bye for now.